Hello friends, this is Chanpreet and I'm your chief mentor of Sophie team. And guys, today I am recording this wonderful video, and I think this is one of the most helpful video which I'll be recording in days to come. Because we know that many retail traders, many beginners, or many experienced traders, investors, sometimes they buy a company and and later they come to know that the company was a junk stock and it was a fraud company. So guys, if you can follow some small steps and basic steps and for yourself, just to cross check, just to make sure the company in which you are investing, the company in which you are trading is a fundamentally strong company, and this which can give conviction for you to stay invested and hold. So instead of following the TV channels, to your friend's advice, or to any XYZ person, guys, or to, even if I may say so, instead of following any guru, guys, if you can make your own investment decisions, don't you think it would be wonderful, guys? Fine. So guys, so let us proceed ahead with this with my presentation, and the topic of the today presentation is how to find a fundamentally strong company the Warren Buffett way. So uh, first of all, friends, there are some important steps as to what you need to do, and some steps which you'll avoid, and it will really help for you to become a mature investor, and then of course even a profitable investor and a trader. Fine. So let us proceed, guys. Important steps to save yourself from a trap disaster by not choosing a weak fraud or a crap company. We know sometimes we follow somebody's advice, or sometimes we have this SMS coming to our mobile that buy this company, it has some news, it's a very fundamentally strong company. So now, guys, you can cross check for yourself and see whether it's a good company or not. So before proceeding, guys, just to make sure that these things you don't do, right? Do not follow the news channel, newspaper recommendations blindly. Always cross-check and do your own simple logical analysis. Believe me, guys, the way Warren Buffett goes into investing is a very simple thing. And as they say, the most difficult thing in life is to do are the simple things, right? So first, guys, don't follow the news channel, newspapers blindly. Always cross-check. Second, just because your best friend, colleague, or any person in a position of authority, which means your boss, or your elder, or somebody whom you think is a mature person, has recommended XYZ limited company, does not mean you have to buy it, right? At the end of the day, guys, just make sure that you are responsible for your own investment decisions, and the decisions on based on which you buy into a stock are logical. It makes sense, right? And even if you want to invest in whatever reason, for whatever reason, do not buy more than 10% of your portfolio. Buy it in two to three parts in every 10% decline. So guys, now suppose you really want to buy into a company which somebody has recommended. Just make sure it is not more than 10% of a portfolio, because going forward, if something disasters happens, if the company has to the stock has to goes down, you'll be down by only 10%. It's only 10% of your portfolio. And as I always tell to my team members, that whatever stock you buy, make sure you're buying in two to three parts, right? And never ever go long in a company in futures market or write a put option until unless it passes the Soki stock check. So guys, I am following what I have done in this presentation. I have noted down a few steps which I'm calling the Soki stock check. And if you follow these follow these steps, I'm sure the company which you are choosing is a fundamentally strong company. It's a high growth stock, and believe me, friends, this is all what Warren Buffett looks before investing into a company, right? So basically, what we are looking for in a company and how can we know whether it's fundamentally strong and also a high growth stock, right? So the first thing, what I want, before we proceed, guys, what I want is that I want you all to bring a white sheet of paper and a pen and note down all these things, because these things are like the golden nuggets which I have learned in last few years, and I'm just giving to you to you all wonderful guys for free, and I just hope that this presentation of mine can save so many investor and retail traders, investors who just fall in for such fraud SMS or advisors, right? So the first thing we want is the EPS to be rising, stable, but certainly not negative and not falling. So what we need to do is, guys, I'll show you from where you can go and find out the EPS of a company. And whenever you draw a virtual graph, the EPS of the company should be going up, or it should be a stable one. But if the EPS is negative, this is the stock which we are not going to buy, right? The second thing which we are going to see is if the company is paying dividend. Why? Because this gives us assurance that it's a stable company, because the company pays dividend out of the profits, so it's a genuine company, right? The third thing which we want is that the operating cash flow of the company of the last 5 to 10 years needs to be positive, and the logic behind this is that how can a company make profits from a negative cash flow? If a company is showing continuous profits, but the operating cash flow of the company is negative, which this hints that there's something wrong in the balance sheet, and the balance sheet is manipulated, right? So if we see that the operating cash flow of the company is negative, this is the company we stay away from, right? And just to mention, guys, most of the banks and financial companies will sometimes, or most of the time, will have negative cash flow, because obviously they are into a business in which they have to lend cash to the depositors and the institutions. So exclude bank and financial companies from this operating cash flow checkup, and rest all the companies which we are investing, it should have a positive cash flow. And the fourth thing which we want is that we want the average ROE, which is also known as the return of equity, above 15% of the last 10 years. Logic is that if a company gives this return, which is 15% on the shareholder money, the management is efficient, and the company, it has a bright future, right? So we want the ROE to be above 15%. The second and the last thing, the last but not the least, is that we want the debt equity ratio of the current financial year to be less than 0.50 or less than 50%, which means I'm borrowing. If I have 10 rupees, I'm borrowing only 5 rupees. Why? Because the logic behind this is that high debt companies, the company which has borrowed too much, more than what they have, during trouble times, during bad or turbulence times, they may tumble, right? They may face a lot of hardships, right? So I'm repeating, guys, note down again. So what we are looking for, number one, we're looking for the earning per share to rise, to be a rising EPS or a stable EPS, but not negative. Second, we'll see if the company is paying dividends, because it gives us assurance that's a stable company. Number three, we want the operating cash flow of last 5 years to be a positive cash flow. Number four, we want the average ROE of the company to be above 15%. And number five, we want the debt equity of the current financial year. If the previous financial year the debt equity is above 0.50, it's okay, it's fine, no problem, guys. But for this financial year, we want the debt equity ratio to be below 0.50, right? So going ahead, guys, another thing is, what are the companies from? Another thing is where we go and find all these things. So this is very simple, guys. What you go is, first, let us look out for companies which have in which the investors have lost money in recent times. So let us go and type look at the financial and the key ratios of auto line industry. So what you're going to do is, guys, it's very simple. Just note it down. You have to type auto line industries, and after that you have to type Morningstar, right? So once you do this, guys, this is what appears. Morningstars, this is the link which appears. You click on the link, and this Morningstar, friends, is a wonderful website. And as I say, this Morningstar is like a guiding star for all you investors, and they give all the information for free, and it's very easy to interpret. So this is the website which we are using, right? So the first of all, when we this is the overview of the company. Fine. So first thing, when we invest into a company, guys, we need to know what is the company into it, right? So the thing is, auto industry is engaged in manufacturing or dealing sheet metal. So you can have a brief intro of the company in which you are investing, just to make sense. And so the first thing we need to do is we need to click on the financial key ratios. And when we do this, guys, we can see we have a 10 years data in front of us. So the first thing we see, remember, guys, is the EPS. So if we see the EPS of 2007 is 14.6, 27, 3.8, 16, 22, 32, 8, minus 32, minus 45, minus 44 is the projected EPS, guys. So first of guys, the first criteria, it fails. And when did auto industries have a negative EPS? It was in 2014, guys, right? For the March 2014. So 2014 was the year where the investors were supposed to get out of this company, right? And we know how the stocks have reacted. It has really fallen down. So we see now, if I draw a virtual graph of the EPS, guys, see how it goes. It goes like this, and this. So the virtual graph of the EPS is going down. This is something which you can draw on your mind. Very easy, guys. So a company which EPS is going down, I stay away from the company. So this company, I need not go ahead and look at all the other parameters, but still, for the sake of teaching you all, I'll just go ahead. So this company is not the company in which we are going to invest. The second thing which we see is the operating cash flow, and we see the operating cash flow is minus, plus, minus, plus, 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 minus, plus. So we see the operating cash flow of the company is mixed up. It's overall we see is kind of negative, and we stay away from this company. Though the company has paid dividend, but if the EPS is going down, it does not make any sense, right? And the second, we need to scroll down, and we see this the ROE, right? We want the ROE of the last 5 to 10 years to be above 15%. So we see the ROE 14, 22, 2, 9, 11, 15, 4, minus 14, minus 23. So the company is giving a negative return on equity, guys. So we stay away from this company. And the last but not the least, we see is the financial health. We click on the financial health, and at the last we have this debt equity ratio, guys, this one. And we want, remember what I said, guys, we want the debt equity ratio to below 0.50, and just to make sure that the company is not over leveraged. So we see the and we are only interested in the current debt equity ratio. So the current debt equity ratio, guys, over here is 0.65, which is clearly above 0.50. So friends, this is the company which you will never ever invest, right? Now let us take another example. Now let us look out Suzlon. So what you are going to do, guys, or I repeat, you need to type Suzlon energy, and followed by Morningstar, and press enter. So once you do so, you look for the link which has this NSE mentioned, and you click on the link. Believe me, guys, if you can follow these basic steps, and if you can do these basic checkups for yourself, and nobody will able to misguide you, right? Your financial decisions, you will be responsible for your financial decisions, and your investment car will be, the steering of investment car will be in your hand, right? So after this, the first thing, the page has loaded, guys. The first thing we click is on the key ratios. Here it is, guys. Fine. So the first thing we see is the EPS, right? So the EPS over here we see is 5, 5.98, 6.89, 1.52, minus 6, minus 7, minus 2, minus 26, minus 15, minus 30. And the projected EPS is minus 1. So we don't invest into a company which gives a negative earning per share. And if you draw a graph, the graph goes like this. So stay away. I'm not investing in this company. The company has pays dividend only once, which shows that it's not a financially it's not a sound company. And the operating cash flow we see is negative, positive, negative, positive, positive, positive. But the thing is, if the earning per share is negative, it hardly matters. I'm not investing in such companies, right? But still, we'll go forward. Let us check the ROE. The ROE is 41, 27, 17 to minus 14, minus 22, minus 8, minus 155. Wow, guys. So the company has been having a negative growth. The EPS of the company is negative, and the company reported its first negative earning per share in 2010. The 2010 was the year in which you need to get out of Suzlon Energy. You are not supposed to be an investor into this company, not even a trader who goes wrong. And we know how the stocks has fallen down, right? So, and if we go ahead and click the financial health, and we see the debt equity, although we don't see any debt over here, which is so what we can do sometimes if we can always go and cross verify in the company's website. In the company's website, they have this section called the investor relations, and where you can see the balance sheet, current balance sheet, and always cross verify, right? Going forward now, guys, this were the examples of some companies which are fundamentally very weak, the companies which you need to avoid. So next time, if any of your friends, investors, or your anybody on news channel asks you to buy any company, guys, what you need to do is you need to go to Morningstar and check for yourself, right? And if you see the criteria which I've told you, it is satisfying, you go ahead and invest, or else you don't invest. Now let us look out for a good company, right? So let us check Amaraja batteries and followed by Morningstar, and you press enter. And once you do so, we're looking for the link which has NSE mentioned in this, and we click on this. And here is the page opening, guys. And so the first thing we click is the key ratios, right? So here it is, guys, last 10 years data of Amaraja battery. Now let us see and cross verify for ourselves whether this company is fundamentally strong or not, right? The first thing we're going to look at is the EPS. Now see the EPS: 6.98, 13, 5, 4, 9, 8, 12, 16, 21, 24. Our projected EPS is 28. So now if I am to draw a virtual graph, guys, the EPS is like this. It goes up, right? So this is fundamentally the company is giving a positive earning per share, which is awesome. The company is also paying dividends from almost from last 6 years, which is awesome, which is also a healthy sign. Operating cash flow of the company is positive, negative, negative, positive, 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 and it's also rising, which is awesome. And then we look at the return of equity, which we want the return of equity of the average or last 5 years, 10 years to be above 15%. So what we have here, guys, ROE of Amaraja batteries 12, 21, 32, 21, 35, 24, 29, 30, 30, 26. Clearly, the ROE is above 15%, which is again awesome. And the last thing we look is the financial health, and we are only interested into the debt equity of the current quarter, guys. The debt equity of the current quarter is 0.04, which is less than 0.50, which is awesome, guys, right? So we see Amaraja is a wonderful company. So if somebody asks you to buy Amaraja, yes, you can consider to buy Amaraja because it's an awesome company, and it has satisfied all the parameters of the Soki stock check, right, guys? And now let me give you example of one more fundamentally strong company. Let us look at Sun TV. Sun TV, and followed by Morningstar, and we press enter. So once we do this, we get this link, guys, the one in which NSE is there. I just hope you're getting amazing value out of this video, guys, because this is all you need to do, right? And you know whether the company is awesome, is a fundamentally strong company, a healthy balance sheet. The balance sheet is growing, the company is growing, and you're bound to make money out of your investments, right? So the first thing we click is on the key ratios. And here it is, guys. Now let us look at the EPS, earning per share. Here it is, guys. So it is 10, 3, 8, 11, 14, 19, 17, 18, 18, 19, 19, right? Now, if I am to draw a virtual graph of the EPS is stable, right? It's not going up dramatically, but at the same time, it's not falling. The EPS is stable. And if I see, the company is also paying a healthy dividend, which is 4, 2, 11, 15, 8, 9, 13, 13, which is awesome, guys. The EPS is stable, so it has satisfied our first parameter. It's paying dividend, which is awesome. It gives us a lot of insurance. Now let us look at the operating cash flow. Operating is positive. So the operating cash flow is growing, and plus is positive for the last 10 years, which is awesome. Now the next thing we look at the return of equity: 36, 32, 27, 29, 29, 36, 29, 26, 25, 24, 24. Awesome. So again, we see the return of equity is above 15%, which clearly states that Sun TV is an awesome company. And the last thing we look is at the financial health, and we are only interested in the latest quarter, guys, right? And this is, so we see the company has no debt. It's a debt-free company, guys. So do you want to put your money into Sun TV? Yes, you should, guys. You should. Now the other thing is, how do you drive the valuations of the company, right? So this is something, again, it's a vast subject, guys, and but I'll give you a small hint. What you're supposed to do is very simple. So you see you see the growth. What is the estimated growth? So the estimated growth, we see ROE expected is over here is around 24%, right? And we see what is earning per share and what is the expected earning per share, right? The expected earning per share for the coming year is 19. So simply, guys, what you need to do is you need to multiply 19 into 24, which gives you a price of 456. And let us see what Sun TV is quoting. Okay, fine, guys. We see Sun TV is quoting at 350. So the price of the company, the valuation which a company is supposed to have is around 450, and it's currently quoting at 350, guys. So what I want you is to just note this down and check the price of Sun TV in the coming few months, and you'll be surprised to find where Sun TV actually the stock prices are, right? And so that's it, guys. So coming back to our presentation once again, guys. Use Morningstar, which is your guiding star. If the company passes the SOKI stock check, you can go ahead and invest. It is always recommended to buy not more than 10% of your portfolio and also accumulate in 2-3 parts. And there are a few more things, guys, which I want to make sure before you entering into a company. Now, first we see the company has has satisfied the SOKI stock check. The EPS is rising. The company is paying dividends. The operating cash flow is positive, and the return of equity is above 15%. The debt equity is below 0.50, and there are a few more things which you can, just to make sure. we need to avoid companies which are highly regulated. We need to avoid companies which are like refinery companies, the companies which are highly regulated by some government decision, right? We also want to avoid companies in which there exists a risk of key people, which means the company uh, is too much dependent on a particular person, and when the company and when the person resigns, it may affect the image of the company, right? So we can avoid such companies, and there's also and we can also avoid companies with R&D risk. We can avoid companies see, the thing is, guys, what you need to do is that you need to close your eyes and think that the particular company in which you are investing, the products or the services of the company, do you think it will be used in next 5 and 10 years, and do you think there will be a constant demand and growth? And what you need to do is you just need to close your eyes and think like Warren Buffett. So the company has satisfied all our parameters, and we've seen the company. We feel the company products and services for next 5-10 years will be in good demand. So you can go ahead and invest. So this is all what Warren Buffett looks while investing and choosing his stock. And after following this stock check, you are now investing like a Warren Buffett, guys. Believe me, guys. This is as simple as this is, guys. This is very simple, right? And congrats, you are now a pro investor, and nobody can fool you. And I'm sure whatever whatever stocks now going ahead, guys, whatever stocks you will buy, just make sure that it satisfies all these parameters. And once it has, I can assure you, guys, it's a fundamentally strong company because there's logic behind everything which I have taught you. And that's it. Till then, take care. Bye bye.